if you're joining us, chances are you've thought about it. I mean, who hasn't? That huge financial challenge.
The big one.
Taking a solid but, manageable amount of money, let's say $50,000, and turning it into that life-changing milestone. $1 million.
Right.
But this isn't about getting lucky. It's not about hype stocks or some secret trade. This is a deep dive into the cold, hard math, into discipline.
Unwavering discipline, really.
Yeah, we're going to be dissecting a very structured, very long-term strategy that's all about consistent contributions and predictable compounding. Welcome to everything you need to know about finance.
And we should say right at the top, just for context,
Yes.
we're analyzing principles and strategies that have been documented for decades. This is an exploration of how these things work. It's not, and I have to be very clear, it is absolutely not financial advice.
For educational purposes only. And hey, if you find this kind of content interesting, please go ahead and like and subscribe. It really helps.
What's so, I think, compelling about this approach right now is how it combines history with what's happening today.
How so?
Well, the fundamentals, time, compounding, that's been the engine of wealth forever. But what's changed recently is this huge shift away from, expensive, actively managed funds.
Of course, passive, low-cost stuff.
Exactly. And this blueprint really leans into that. The idea is that in today's world, controlled risk and just playing the probabilities gives you a much, much higher chance of success than trying to outsmart the entire market.
It makes sense. You're basically using time as your main tool. So the mission for today is clear. We're going to walk through the 6 key steps laid out in this blueprint for maximizing your odds of hitting that 7-figure goal, all with controlled risk. It's really a formula built on behavior, not bravado.
That's a great way to put it.
So let's start with the most important part, the math. The inputs you absolutely need for this to work.
Right, the non-negotiables.
The plan really hinges on 2 key assumptions. First, you need some seed capital, an initial investment of $50,000.
And second, and this is maybe the harder part, you need the engine. A consistent $1,000 monthly contribution.
$12,000 a year. It's aggressive, but it's doable for someone who's serious.
And when you run those numbers, you just immediately see the power of time. We're not talking about fantasy returns here. We're talking about realistic long-term market averages.
So what does that look like?
If we just assume a 10% average annual return, that $1 million goal, it comes into view in about 22 to 23 years.
Whoa, 22 years.
Uh-huh.
That's a serious commitment. But how much does that change if you can do a little better, if you can squeeze out a bit more performance?
It's incredibly sensitive. If you can push their average return to, say, 12% a year, which is not out of the question with good strategy and low fees, that timeline shrinks a lot.
To what?
You're suddenly looking at 19 to 20 years.
Just from 2 percentage points?
Just from 2 points. You just bought yourself 3 or 4 years of your life back. That is the power of compounding working over 2 decades.
That's incredible. 3 to 4 years just shaved off. It really shows you that these small percentages aren't just academic figures. They are huge time savers.
Exactly. And this brings up a critical behavioral point that the blueprint really focuses on.
Okay.
In the early years, let's say the first 5 to 7 years, your own contributions are still doing most of the work. The market gains are small in comparison.
Right. I've heard this called the Valley of Despair. It feels so slow.
It feels incredibly slow. You put in $50,000, you're adding $12,000 a year, and after 7 years, the account might only be worth $150,000. You feel like it's not working.
And that's the danger zone.
That is the danger zone. Sticking with that $1,000 contribution during that phase is the whole game, because
Sure.
you're setting the stage for when compounding finally takes over and really starts doing the heavy lifting for you.
So the big takeaway here is that most of the work is done by time and discipline. The consistency, not by trying to find some lottery ticket stock.
That's it. And that target rate of return, that 10 to 12%, it basically dictates the entire strategy you need to follow.
Which brings us to the structure. How do you actually build a portfolio to do this?
Well, since the goal is predictable compounding and crucially not blowing up your capital, you need a structure that gives you stability but also some room for growth.
And that leads directly to the core satellite approach.
Yes, the core satellite framework.
I like this framework because it sort of acknowledges that we're human. We want the boring stability that gets us to the goal, but we also want a little bit of that excitement, that potential upside. It builds discipline into the system.
It does. And the blueprint is really strict about the split. It's a 70-20-10 split.
Okay, let's drill into that. The 70% core.
Yeah.
This is the foundation, right? It has to do all the heavy lifting.
It has to be boring, powerful, and cheap. The blueprint says this has to be long-term equity ETFs, exchange-traded funds.
And why ETF specifically?
Fees? Their management fees are tiny. So more of your money is actually working for you instead of going to some fund manager. You can't hit that 10 or 12% target if you're giving away 1 or 2% in fees every single year. It just kills the math.
Makes sense. So for that 70%, what's the allocation look like?
It's all about capturing global growth. So roughly 50% goes to the U.S. market, think an S&P 500 or a total market index, and the other 20% goes into international equities.
So you're diversified across the globe.
You're protected. You don't have all your eggs in one country's basket, which is a risk you have to manage. The thinking is, if this 70% core fails, the whole plan fails. It's that important.
Okay, so that's our defense. The 70% provides the stability. How does the 20% satellite work? That's our offense, I assume.
That's your offense. This 20% is where you actively try to generate alpha.
And for anyone who doesn't know, alpha is just...
It's just the extra return you get above a benchmark, like the S&P 500. This is the bucket where you get to make some active decisions.
What kind of decisions are we talking about here?
We're talking about maybe buying individual growth stocks or some very specific thematic ETFs, things that focus on, huge secular trends like AI or renewable energy or semiconductors. The key is quality companies with strong balance sheets and real cash flow.
Hang on, though. If the whole point is this disciplined, predictable compounding, why are we putting 30% of the portfolio into these riskier alpha-seeking buckets? Doesn't that sort of contradict the whole idea of not trying to be a star stock picker?
That is an excellent question. And the blueprint handles that by putting really strict guardrails on it. The 70% core is mathematically designed to get you to the goal by itself. That's your safety net.
Yeah.
The other 30% exists for a few reasons. For potential acceleration, sure, but also to satisfy that human urge to speculate, but in a controlled way.
So what are the rules for that satellite bucket?
They're non-negotiable. First, no single stock or position can be more than 5% of your total portfolio value.
So no going all in on one idea.
Never. Second, you have to hold these for years, not weeks. This is investing, not trading. And third, and this is maybe the hardest rule, you add during market fear, not market hype.
Buy when there's blood in the streets.
When everyone else is panicking. If a stock is all over the news, you've probably already missed the best entry point.
Okay. That leaves the last 10%. The optional or learning capital. I'm guessing this is where the really wild ideas go.
Precisely. This is where you can test a hypothesis. It's the part of the portfolio that, if it goes to zero, you're disappointed, but your main 20-year plan is totally fine. It's still on track.
You mentioned options earlier. Is this where that would fit?
Yes, but the blueprint is very specific. If you do auctions, it should be income-generating strategies, like covered calls, not just buying calls or puts and hoping.
You're selling someone the right to buy a stock you already own.
Right. It caps your upside, but you get paid an income premium right away. It's a much safer way to engage. This 10% is where you test your theories without betting the farm.
We've got the structure. So now, step 4. The mechanics. Investing that $1,000 every single month. This has to be the hardest part psychologically.
It is. It's the simplest rule, but it requires the most mental fortitude. And the key is to automate it completely.
Set it and forget it.
You invest automatically every month and you just ignore the noise, ignore the headlines about inflation, ignore the hype about the next big thing. You just use dollar cost averaging.
ECA, meaning you invest the same amount every month no matter what the price is.
Right. Sometimes you buy high, sometimes you buy low. It averages out and completely removes the emotion of trying to time the market, which is a loser's game.
So for that $1,000 a month, you'd automate, what, 700 into the core ETS?
200 into your growth bucket and the last 100 into that optional bucket. Automating it makes it effortless to stick to the plan.
And it also prepares you for what the blueprint calls the crash accelerator.
Yes, this is so important. Most people see the market drop 20% and they freeze. Or worse, they sell. The blueprint says you do the exact opposite. This is when you should try to shift more capital into your core equities if you can. You are literally buying shares on sale. You're buying future growth at a massive discount.
That takes nerves of steel.
Mm-hmm.
Which brings us right to step 5, risk management. Or, as the material puts it, how people actually fail to reach the goal.
Because the best plan in the world doesn't matter if you can't stick to it. The behavioral part is everything. There are basically 4 commandments to prevent failure.
Okay, lay them out for us.
First, never stop your monthly contributions. Unless your income completely disappears, you keep feeding the machine. Consistency is everything.
And second,
Second, never ever liquidate during a crash. Selling just locks in your loss and guarantees you'll miss the recovery. It can add years to your timeline.
that's the one that gets everybody. You see your account down 30%, you feel like an idiot, and your brain is just screaming at you to sell and save what's left.
It is the single greatest temptation. But you have to remember, 20% drops are normal. They happen every few years. 30% drops are painful, but they're survivable.
And even 50% drops.
Even those are survivable if you don't sell. Compounding only works if you stay in the game. The recovery after a crash is where you make so much of your money because all those cheap shares you bought start to multiply.
So discipline during a crash is the only thing that matters. What are the other 2 commandments?
Third, you rebalance your portfolio, but only once a year. Maximum.
To get back to that 702 at 10 split.
Exactly. It controls your risk. And finally, and this is huge, no leverage, no margin loans, no borrowing money to invest.
Why not? It can magnify your gains.
It magnifies gains, but it absolutely destroys you during a downturn. It can force you to sell at the worst possible time. It's the fastest way to blow up a long-term plan.
Okay, so we've covered the structure, the discipline, the survival rules. But there's one last piece, step 6. The material calls it the hidden accelerator. And it says this is actually more powerful than trying to chase a higher return, like 14 or 15%.
That's because the market's return is out of your control. This accelerator is 100% within your control.
And it is?
Simply increasing your contributions.
That's it.
That's it. If, say, 5 years into this plan, your income goes up and you can increase your monthly savings from $1,000 to $1,500, it will cut years off your journey. It's more effective than almost anything else you can do.
Let's just put some numbers on that. We said it takes about 22 years with $1,000 a month at a 10% return.
Right. But if you stick with that for 5 years and then manage to bump it up to $1,500 a month for the rest of the time, you can cut that 22-year timeline down to under 18 years.
Wow, you just bought back another 4 years.
It's a huge controllable lever. People obsess over finding the next 10x stock, but the most reliable way to get rich faster is just to save more money as your career progresses.
It puts the power back in your hands. It's not about the market. It's about your own earning and saving habits.
Exactly.
So let's bring this all together. This plan is definitely not a get-rich-quick scheme.
Not at all.
It's not about timing the market. It's not about predicting the economy. And let's be honest, for most of the time, it's not very exciting.
And the documents are clear that its lack of excitement is precisely why it works so well.
It's a high-probability, controlled path to $1 million that doesn't involve gambling.
Right. By focusing on that stable, diversified 70% core, and you combine that with automated contributions and strict rules against panic selling, you give compounding the time and stability it needs to work its magic. This kind of long-term thinking, that's the future of the portfolio for anyone who's serious about building wealth.
Okay, so our final provocative thought for you to think about today centers on the value of time. The early years of contributing are often more powerful, more impactful on the final number than the later years of compounding. That very first $1,000 contribution you make, 22 years before the finish line, has more than 2 decades to grow and multiply. Every single day you wait to start a disciplined process like this, you lose leverage that you can never get back.
Well said.
If you enjoyed this deep dive into disciplined wealth building and the math behind reaching 7 figures, make sure to try out our latest episodes for more dives into the topics that matter most. We'll see you next time.